Hey guys, I hope you guys are doing good today. Think about this for a second. Every road you drive on, every bridge you cross, every affordable home which was built in India, all of it needs only one thing, that is called cement. India is the world's second largest cement producer, and this particular industry, it is expected to grow 7 to 8% every year through financial year of 27. Indian government has allocated 3.09 lakh of crores just for a roads this year budget. And right now, Ambuja Cements, India's second biggest cement maker, which is sitting near to 2-year low, and it is trading. Let's understand, this company is completely broken, or is it just a broken price? Let's find out with actual numbers, with financial data. So without wasting any time, we can quickly get into the video. Before that, if you're new to my channel, please do subscribe it and do hit a like button if you like this video. Let's go. So let's start with what is Ambuja Cement is doing. Point number one, this particular company is India's second largest cement maker. When you look at the revenue, the financial year of 26, which is 40,656 crores. When you look at the capacity, they do have 108 of MTPA, million tons per annum, which is across 24 integrated plants and 22 grinding units. And also they control ACC, Shanghai Cements, Penna and the Orient Cements, which is completely under Adani Cement umbrella. The combined Adani Cement Group, it holds literally 16.6% of the market share in India. Number two, Adani took over this particular company in 2022. So it acquired from the Swiss giant called Holcim for $10.5 billion. And the Adani family, they literally pumped 20,000 crores via the warrant at 409 rupees per share. The promoter stake, it got risen 70% and they are deeply committed. Obviously, this is the single biggest transformation for this company. Point number three, what exactly they sell? They have Ambuja Cement, Ambuja Kavashi and Ambuja Plus. It has a multiple grades for multiple use cases. So basically, this saves for home builders, masons, contractors and mostly for the infrastructure projects. Now they are pushing for the premiumization, higher margin blended and the specialty cement. Number four, they do have an aggressive expansion underway. They do have a target to scale up to 140 MTPA for next 2 years. Their capital work in progress, which has jumped from 2,658 crores in financial year of 24 to 9,121 crores in financial year of 26. Their net block, it's also jumped from 32,194 crores to 58,263 crores in the same period. This looks like an active and growth mode company. This is not the sleepy one. Point number five, their sale recovery is completely real. In financial year of 26, it was having 40,656 crores, which is 15.1% over financial year of 25. When you look at the 2-year CAGR revenue from financial year of 24 to financial year of 25, which is 10.7%. After the dip in financial year of 24, they do had 33,160 crores. That particular top line, it got bounced back strongly. Now let's understand why this particular stock is at 2-year low. So this particular stock, it got hit at 612 rupees in March 2024 and today it trades around 425 rupees. This is exactly a 30% of the fall. I do have 6 reasons why exactly there is a fall. Reason number one, their ROCE is completely collapsed. When you look at the financial year of 21, their ROCE is 19.6%. And in 24, they had 11.3%. In 25, which is 6.8%, and 26, they had 5.0%. This is obviously a single most alarming data for this particular company. Market is pricing correctly, declining the return on capital employed, which is a serious issue. The reason number two, the massive capex, which is destroying the near-term returns. When you look at the investing cash flow for this company, this is something very important data that you need to note. In financial year of 23, they had minus 14,481 crores. In 24, they had like minus 8,941 crores, and in financial year of 25 they had minus 7,529 crores, and finally in financial year of 26, which is like minus 7,935 crores. So this looks like the company is spending relentlessly for the capacity expansion. This depressed ROCE, which is temporarily, but the bet is that the utilization will fill up the new plants. The reason number three, the Q3 financial year of 26, the earnings were terrible. When you look at the Q3 financial year of 26, 2026 in the period of October to December 2025. They had a net profit just 240 crores. Obviously, this is a shocking drop. When you look at their operating profit margin, it fell literally 13.2% in Q3 financial year of 26 from 19.2% in Q2 financial year of 26. The reason is the fuel cost, basically like pet coke and the coal, the packaging cost, and finally the rupee depreciation all hit together. So this spooked the investors badly. Reason number 4, operating margins are volatile. The peak operating profit margin, which is 21.4% in December 2021. In financial year of 23, post Adani acquisition transition year, the operating profit margin, it completely dropped to 13.2%. In financial year of 26, the full year operating profit margin is 16.2%, which is something still below 20% from its peak. The inconsistency in the margin signals the cost control challenges. Reason number 5, the operating cash flow, which is completely inconsistent. In financial year of 23, the operating cash flow, which is like 735 crores, this is like extremely low for this company's size. In financial year of 25, the operating cash flow, which is like 2,237 crores. This is again low. In financial year of 26, it got improved to 5,362 crores. But the inconsistency is completely a concern. When operating cash flow and the profit after tax, if it doesn't match, it raises the question about the earning quality. Number 6, the stock was overvalued at a peak. In March 2024, the stock, it was trading at 612 rupees with the PE of 37.7x. This is something clearly overvalued. Adani acquisition excitement, it praised it too much. The current PE for this particular stock is 21.2x. This is the first time where the stock, it looks reasonably praised in year. Some of the fall was justified as re-rating, and this is not a business deterioration. Now let's talk about the fundamentals. Let's start with the revenue and the profit quality. Their sales growth, it looks like a mixed story. When you look at the 10-year CAGR from financial year of 16 to financial year of 26, which is like 7.3%. So this is in line with industry growth rate. When you look at the 3-year of CAGR from financial year of 23 to financial year of 26, it is just 1.5%, which is completely disappointing. And when you look at for the last 1 year from financial year of 25 to financial year of 26, it is like 15.1%. This looks like a genuine recovery, and this is an highest in the recent years. When you look at the financial year of 26 quarterly trend, all 4 quarters were above 9,000 crores, and it is something like consistent volume. Now let's look at the net profit quality. We have to check this carefully. In financial year of 26, the full profit after tax, which is like 4,728 crores. But look at Q3 financial year of 26, the profit after tax, it was just only 240 crores. And in Q2 financial year of 26, the profit after tax, it was 1,766 crores. But the tax line, it shows minus 1,456 crores. So what exactly this means? The Q2 profit, it was completely inflated by a large tax reversal, and it is not a genuine operation. When you look at the underlying quarterly operating profit are more like 800 crores to 1,000 crores. We have to be careful while reading this profit after tax. The tax adjustments are distorting the numbers. Let's understand the revenue is genuine or not. When you look at the revenue growth, it comes from the cement volume, not from an asset sales. I do not see any signs of revenue manipulations through related party routes in the data. However, the large other incomes in financial year of 25, which is like 2,646 crores, it needs an complete attention. Unusually, the highly compared to 447 crores in financial year of 23 and the 516 crores in financial year of 26. So this is like in financial year of 26, the spike may have come from the one-time income item. So let's talk about the return ratios. ROE, which is completely declining and the concerning. Okay, now let's look at the data. In December 16th, they had around like 5.6%. In December 21, they had like 11.0%. That is both are same. So when you look at for last 3 years, the ROE, which was completely struck at 8.0%. So there is no improvement here. For a context, the good business, it should deliver an ROE more than 15%. So the Ambuja is clearly not in that category right now. So let's talk about the ROCE. This is a red flag for this company. When you look at the data, the December 21, they had like 19.6%, which is the best ever. In 23, in March 26, which is like 5.0%. So the ROCE is now below the typical cost of capital. So what exactly this means to us? Every rupee of the capital employed is generating barely 5 paisa of return. The main reason for this particular issue is the massive new asset yet. Let's talk about the cash flow. The rule number 1, the operating cash flow, it should be in positive. In financial year of 24, they had like 5,646 crores. This is okay. okay, good. In 25, they had like 2,237 crores. This is okay, not completely good. Like in financial year of 26, they had like 5,362 crores. This is something looks like a recovery. Let's talk about the investing cash flow. It should be in negative. This exactly defines the company is investing. When you look at the financial year of 23, which is like minus 14,481 crores. In financial year of 24, which is like minus 8,941 crores. In 25, like minus 7,529 crores. In 26, like minus 7,935 crores. So this looks like the company is actively investing and they are not something like divesting. Rule number 3, let's check what exactly happening on financing cash flow. The financial year of 23, they had like plus 2,931 crores. This looks like they have raised the money and obviously this is an Adani warrant infusions. In financial year of 24, they had like plus 5,689 crores. Obviously, the more warrant money has been come in. Now let's see what exactly happened on financial year of 26. This is like minus 1,629 crores. It looks like the net outflow. They were paying the dividends and certain minimal borrowings were happened. The financing inflows were Adani pumping the equity. That is why you can see the reserve, it got jumped from 31,301 crore to 58,853 crores. This is an equity funding, not a debt. And this looks like a positive sign. There is one core concern where the operating cash flow versus the profit after tax gap. When you look at the financial year of 25, the profit after tax, it was like 4,303 crores. But when you look at the operating cash flow, it was 2,237 crores. When you look at the gap, they had like 2,666 crores. This looks like an complete yellow flag. So what I understand, this is like an working capital absorption or something like a receivables buildup. Look at the financial year of 26, the 1,728 crores and the operating cash flow is 5,362 crores. This is something like back in certain alignment and obviously it is a good sign. Let's talk about the debt analysis. For this company, it is completely a debt free right now, which is something a biggest positive here. When you look at the bond, they had something like 8,666 crores against the reserve of 58,853 crores. The debt to equity for this particular company is 0.015. This is completely negligible. The net debt is basically zero. 958 crore cash versus 866 crores of borrowing is equal to nearly a net cash. So the borrowings have been slowly creeping up, 29 crores in financial year of 16 to 866 crores right now. When you look at from the absolute terms versus the size of the company, this looks like the completely manageable. So this is only one metric where the Ambuja score excellently. Okay, now let's talk about the promoter integrity. Let's start with what is positive. The zero promoter shares pledged confirmed in financial year of 26. This is like a clean filling. The promoter, they have invested 20,000 crores at 419 rupees per share and currently it is like 427 rupees. They are barely above the cost. The promoter holding, it got increased from 63% to 70% and they are not reducing the stake. Okay, what I am cautious about, the SEBI was investigating insider trade in Ambuja's share in 2022 to 2023. They were covering this activity from July to October 2022. Similarly, Adani Green case was disposed. No conclusive evidence was found. When you look at the Ambuja's specific probe, no penalties as of now in June 2026, but the open investigation is a flag. In financial year of 23, basically a transition year, when you look at the operating cash flow, it was just 735 crores. But when you look at the company's revenue, it was having around 38,937 crores. This raises the questions here. Now let's talk about the valuation. As a value investor, I always look into the margin of safety. Let me check the 427 rupees per share. Is it a right price? Let's check. You look at the current PE for this company, which is having like 21.6x or something like that. And when you look at the EPS from the data, which is like 19 rupees in financial year of 26 at the price of 427 rupees, the PE is 22.3x. The industry average PE, which is approximately 29x. And when you look at the Ambuja, this is trading at 23% of the discount to this sector. This is something new. When you look at for the last 3 years, this stock, it got traded at around like 28x to 38x. Obviously, it was completely expensive. So this is the first time where the PE, it got completely compressed to the reasonable zone. When you look at the historical PE at the context, in December 16, they had around like 37.1x. In December 21, they have like 27x, which is fair value. In March 24, which was trading around like 37.7x, which is completely expensive. And today, it was trading around like 21.2x, something like that. This is somewhat like reasonable in the most recent decade. Now let's understand what is there in the price to book value. The price to book value for this particular stock is 1.67. This is the first time below 2x in years. When you look at the book value per share in financial year of 26, they had like equity of 59,347 crores. When you divide that with 247.18 crore shares, which is equal to 240 rupees per share at 427 rupees, which is equal to 1.78x. The industry average PB, which is approximately 2x to 2.5x. So the Ambuja, which is trading at below the industry average price to book value. This is actually positive for the value of investment. When you look at the ROE, which is like only 8%, and when you look at the sub 2x of price to book value, which is not a cheap, it's a fair value right now, is my honest take. So what I like about this company: number one, it is almost debt-free company. Number two, the revenue recovery is real. In financial year of 26, the sales is 15.1%. So this is the best growth in the recent years. Number three, the promoter is all in. So the 20,000 crores of promoter money, it is completely infused for 419 rupees per share. Zero shares pledged. Promoter stake is going up and it is not going down. Point number four, the sector tailwind is a decade long. 7 to 8% of the CAGR demand growth, which is confirmed through financial year of 27. The fifth one is PE is finally reasonable. Okay, now let's talk about what exactly worries me. The point number one, which is ROCE. This is like 5%. It is not at all acceptable. From 19.6% in financial year of 21 to just 5% in financial year of 26. Number two, the operating cash flow inconsistency. When you look at the financial year of 23, they only had 735 crores of operating cash flow on 38,937 crores of revenue. This is something wrong here. But I need to see the consistency for at least 2 to 3 quarters. Number three, the quarterly profit after tax is completely unreliable. In Q3 financial year of 26, the profit after tax, which is like 240 crores. Obviously, this is a terrible. Point number four, the SEBI probe is still open. Five, there is no margin of safety at the current price. At 427 rupees, this stock is fairly priced. It's not at all cheap. I'm a value investor. I won't pay for the fair value, and I obviously wait for the discount. At 427 rupees today is not at all a cheap, it's a fair value. And I will completely avoid at the moment. Okay, that's all I have. I hope you might have enjoyed this particular video. If you liked it, please do hit like, but please do comment about your thoughts on this company. I'm happy to read all your comments. We'll see you on another good video. Till then, bye.